Um, okay, yes, good evening once again, everyone, and welcome back to class. This is our second class so far for this cohort, October cohort of the Financial Analysis Masterclass organized by Plus Business School. So yeah, welcome back to class. So in today's class, we are going to look at understanding industry structure, business models, and strategy links. So we are looking at the second week. We are still under module one. We'll be wrapping up with module one today, and we'll look at some practical aspects. Yes, we'll go through some practical aspects of Excel. Yeah, so the first tool we'll be looking at for our financial analysis is Microsoft Excel. Yes, so um, today we are looking at foundation for strategic financial analysis. So that's what we are focusing on today. Please and please, once again, if you were not in the last class, you need to watch the video of our last class so that you can catch up with us so that you are not lagging behind. So please, let's try as much as possible to watch the video the moment it gets to us. All right, so let's just dive into what we have for today quickly. So now, let's look at understanding industry structure. So now, anytime we want to conduct financial analysis, the first thing we ask ourselves is, which industry am I analyzing the data? So you need to understand the industry. If you don't understand the industry, your analysis won't be complete. Yeah. Yeah. So a proper understanding of the industry is very, very important. So you need to understand the industry structure. So when we're talking about industry structure, what do we mean? An industry structure describes how the companies within a sector are organized and how they compete among themselves, how they produce their products, and how they generate profits after they have deducted their expenses from their revenue. So yeah, so that is the industry structure. So the industry structure help you to understand, okay, what is the benchmark that you are going to use for your analysis? And that's why industry analysis is also very, very important. Yes, it is the fundamental landscape that determines the potential for financial success. So now, we need to look at the key players in the industry. So the key players are the market leader. So as a financial analyst or as a prospective financial analyst, you need to ask yourself this question. Who is the market leaders of my industry? Or who are the market leaders of my industry? Or who is the market leader if it is just one company that is leading? So there are some cases that, oh, we have different companies, one company lead at a particular point in time, another company lead, just like those days where you were in a secondary school, they would tell you that, oh, this person has the first position, this person has the second, and this person has the third. For some people, maybe the first position is always retained by somebody, because that guy is a scholar, he's always coming out as the first position. So, but for some cases, you can see maybe there is competition. This person has the first this time. Next time, another person comes out as the first. So why the person that took first last time becomes second, and the third time, somebody that took fifth last time came out as the first. So it happens. It happens. So yeah. So in business, we also determine that who is the market leader, who is at the top. Is it just one company that's been at the top for a long period of time, or do we have more companies? Is it changing? Is it changing? Market leadership, is it changing? So who are the challengers? Yes, who are the challengers? So the challengers are your competitors. The competitors are people that don't want you to do well because of the fact that they have better systems put in place. Yeah. Then the new entrants are also things you need to consider for the business. Who are the new entrants? So new entrants are new businesses that are starting what you are doing. So yeah, so those are the key players that you look at when you're doing industry analysis. We also look at revenue generation. So you need to tell us how income is being earned. How do we earn our income? Is it price driven? Is it volume driven or is it value driven? So when we say price driven, does it mean that, okay, the price of the product is on the high side and people still buy, notwithstanding? Just like, for instance, Apple. A lot of people don't buy Apple. It's just the few that usually buy Apple products. But the company makes substantial revenue from the sale of one Apple product. Yes, because the profit margin for that kind of product is on the high side. So that is price driven. There are some product like FMCG products, fast moving consumer goods. These ones are volume driven. The company make more revenue depending on more volume, more quantity that is being sold. So that is fast moving. And people, the products are in high demand. In short, if your profit margin is just 10%, you can make millions of profits because the product is in high demand. So that is volume driven. We also have some products that are value driven. So you need to know the revenue generation model as part of the industry. Yeah. Then the cost profile is something you also need to look at. So this cost profile set the nature of the cost as well as the margin. So you need to look at, okay, what's the element of fixed cost, what's the element of variable cost, you know? So fixed costs are those costs that it doesn't affect the activity level. So the activity level is talking about the units sold. So there are some costs that if you like sell 100, if you like sell 500, if you like sell 1 million, you will still incur the same cost. So those costs, especially when you have a fixed salary, you have the rent. Let's say, for instance, your factory where you are using to produce, you have a rent. If you sell 1,000, if you sell 100, if you did not even sell at all, you still pay your rent. So the rent is a fixed cost. The variable costs are costs that increase from time to time, depending on the activity level. So the more you sell, the more cost you incur. Yeah. So the cost of your materials, for those in the manufacturing industry, for those in the other industry, there are some also element of fixed costs and variable costs. Now, we also have some mixed cost, but as time goes on, you understand what this is all about. So we also have the market dynamics. Yes, the market dynamics establish the level of regulation and competitive intensity. So yeah, so that's just what industry structure is all about. Now, we have some frameworks that we need to look at. So like these are strategic management tools, and we also call them business analysis. So as a financial analyst or a financial analysis expert or prospective financial analyst, you also need to be aware of the business analytics aspects. So Porter's five forces is one of the business analysis tools that financial analysts can also use. Now, the Porter's five forces model um, talks about five different things, and it's talking about competition. So it also has to do with the industry that the business operates. So like competitive rivalry. Now, any business that has rivalry, it's an element that that business will thrive. Yes. So like, oh, somebody I know it's common maybe in this part of the world, yeah, in Nigeria. I understand that okay, we have somebody joining outside Nigeria currently. So yeah. But here in Nigeria, if somebody says that somebody started a new business and the person is doing very well, the person is making massive revenue, the profit is on the high side, if other people find out, they also tend to do the same thing the person is doing so that they can also make profit and make sales. So that is what we call competitive rivalry. So if you are able to come up with a business idea that others see that, oh, wow, this business is doing well, oh, let me also do the same thing. And they see reasons to do the same thing you are doing. So it means that there is a competitive rivalry. So that is what Porter's 5 forces model is all about. Yeah. So if people see what you are doing and they say, ah, no, I beg, I don't have time, it means that maybe the business is not doing well. You understand? So it means that there is no competitive rivalry in that kind of business. So competitive rivalry has to do with the number and aggressiveness of current competitors directly impacting price power and the gross margins. So yeah. So we also have threat of new entrants. So new entrant, as I've said, is like the new people coming into the business because they see that you are doing well. They say, ah, let me also do what you are doing. Yes. So just like some years back, we saw the biggie coming into the you know, soft drink industry and joining the big guys like Coca-Cola, 7 Up, and the like. So they came up and say, oh, we can also make the big name. So yeah, so they actually came in. So that's threat of new entrant. Now, how do you look at threat of new entrants? You should look at, okay, how easy can somebody start this business? Is this business easy to start? So if the business is very easy to start, that, oh, if you have maybe 300,000, 200,000, you can start a business. So yes, somebody can easily save 300,000, within the space of few months and start a business. So it means that the threat of new entrants will be high. That means a lot of people can still do the same business you are doing. But if you are doing a business that requires billions of investments before people can start it, then it means that the threat of new entrants is low. The threat of new entrants is low. So threat of new entrant has to do with the high entry barriers that lead to more stable profits. Ease of entry allows quick erosion of established margins. So exactly.
Hello, Diola. Ẹ kú iṣẹ́ òní o. Àwọn ọmọ mi ń kọ́ àti pásítọ̀ tí o.
So so that is actually uh that is actually that. That is actually that. If you have any question, you can raise up your hand. I think I'll be muting everybody now, so avoid noise. Yes, to avoid noise. But if you have any question, just call my attention or use the chat. If I don't see the chat, maybe you should just raise up your hand so that I can give you the access to ask your questions. But for now, I'll be muting everyone. Yeah, so that we can move at a very fast pace. Now, the third is bargaining power of suppliers. Bargaining power of suppliers has to do with now the suppliers control the input cost. So their power influences the company cost of sales and ultimate the profit margin. So the suppliers, they control the cost of the business. Yes, the suppliers control the cost. So now, if we have more suppliers in the industry, then it means that the cost may be low because we have more suppliers. So it will be competitive. So it means that if this guy's cost is high for you, you can move to another supplier and say, ah, if you can reduce the price, I will patronize you. But if it is only one supplier you have, that person will see himself as a monopoly and he can just give you any price. Since that is your business and you don't have any other alternative, you don't have a choice. You have to accept the price that is given to you. So which is the cost. So and that's why we say that the suppliers controls the input cost. So their power influences the company cost of sales and ultimate profit margin. So depending on the number of suppliers you have in that industry. Now, bargaining power of customers. Now, customers also have their bargaining power. Now, bargaining power of customers may not be really, really much if you are the only person that have this product that you sell, or you are the only one that render the service. So you can just pitch your product to as many people that would buy it at the amount you intend to sell. But just in case you have other people that, do the same thing you do, you may have to use that as a benchmark so that you don't shoot yourself in the leg and you don't charge a price that is higher that your customer cannot afford and will chase them away. So that is where the bargaining power of customer is very, very important. Then threat of substitute is the fifth one under the Porter's five forces model. So it's saying that, okay, are there alternative products that your customer can buy if they're not getting value from your own product? So this also gives competition. So in summary, Porter's five forces model look at how competitive a business is using these five frameworks. So looking at the example we have below, we say that the Nigerian telecom industry has high capital barrier, low threat of new entrants. So for you to go into the telecommunication business, there are a lot of things to do. Yes, there are a lot of expenses that you incurred. You spend a lot of money. So it's not something that anybody can just start anyhow. So this makes the low threat of new entrants, yes, and resulting in stable earnings for operators like MTN, Airtel, Glo, and the likes. Unlike the FMCG industry, which faces intense rivalry and consumer price sensitivity. Yeah, so for FMCG, their products, it doesn't require much technicality and, you know, and it doesn't require high capital to start. So, somebody that has an idea can just start the business. They invest maybe 1 million or less, and the business starts. So something like that. So for that, we can say that the cost of new entrant, the threat of new entrant is very, very high for that kind of industry. So this also has to do with you understanding the industry of the business that you are analyzing. So the next thing we'll be looking at quickly, in the next 10, 15 minutes, we'll be done with the theoretical aspects of this class so that we can dive into the practical aspect of the class. So yeah, so that's just that. So we have the industry-specific financial drivers, that we need to look at. So for financial analysis, must always begin with industry context. Please take note of this. Without it, ratio analysis becomes misleading and incomplete. So if you don't understand the industry of the business you're analyzing, your ratio analysis will be useless and misleading. Yes. So every sector has unique drivers. And you need to understand the unique drivers of the industry that you are analyzing. So for example, FMCG, which is fast-moving consumer goods, the key financial drivers are the sales volume. So FMCG, as the name implies, fast-moving. The goods are fast-moving. So the sales volume is on the high side. So the key financial drivers is the sales volume. So anytime you're analyzing, you are always analyzing the what? The sales volume of that kind of a business. So you also look at the distribution efficiency. You also look at the cost of raw material. When you're analyzing, the analysts focus on monitoring the gross margin and also monitor the inventory turnover. Now, in the practical aspect of this class, we'll be looking at some of the ratios and you understand quite a bit of them. So yeah. So for the manufacturing company, the key financial drivers are capacity utilization. So when we talk about capacity utilization, it's like, okay, the warehouse, what's the capacity of the warehouse? So if you are producing 1,000 units every day, do you have enough storage? Yes, for what you are producing on a daily basis. So that also has to do with your capacity. Do you have the right tools to ensure that if the daily demand increase from 1,000 to 1,500, do you have enough human resource, like people working in your factory that can produce 500 extra? Do you have enough machine that can do the job. So that's capacity utilization, input cost, energy, transport, and also capital expenditure. So these are the key financial drivers that you pay attention to for a manufacturing company. Then the analysts focus on tracking the cost to sales ratio and also the fixed asset turnover. Okay, you may not be able to understand, you may not be able to understand, you may not be able to understand these ratios now, but we are still in the introductory aspect of the course. And as time goes on, we are going to explain more on what the ratio is all about. So yes, so for technology firm, just like the telecom, you know, they look at subscriber growth. You know, the technology firm, they are more of service firm. They render service. Yeah. Now, when you like the telecoms, for instance, the product, what they give you is service. You're able to call somebody and the person is hearing you. That's the service they provide. So now their growth depends on subscribers. Subscribers are people that have, for instance, MTN. It's only people that have MTN SIM that will patronize MTN. If I have Glo, there's no way I can buy MTN recharge card. Never. So the number of subscriber that is part of the key financial drivers. So you need to understand this. And also the average revenue per users is some of the things that they need to also look at. Okay, if our revenue for this month is 500 million, how many subscribers do we have? Then we can then determine the average revenue per user. So now the infrastructure investment is also some of the things they consider. Now, while analyzing, the analysis focus on revenue growth. Yes, for companies in the technology industry, we focus on the revenue growth. We also look at the capital expenditure trends. So yes, because technology firm, they invest more in technology, yes. So the next is actually the banking and financial services. So for the banking and financial services, their key drivers are the interest spread. Yes, because the firms in the banking industry, they work with interest. The loan quality, the NPLs, like the NPL means non-performing loans. Then they also look at regulatory capital. They look at regulatory capital. These are the key financial drivers. And now the analysts focus on the net interest margin, which is NIM, the NPL ratio, the return on equity, and the likes. So these are the things that the analysts focus on. Then for oil and gas businesses, the focus on the drivers, the financial drivers are crude price movements, the operating costs, the production volume. So because this also has to do with production of oil, gas and the likes, gasoline products and the like. So yeah. So it also has to do with production volume, the operating costs, as well as the crude price movement. So the analysts focus on the profitability, then the commodity price exposure. So now the summary is that you need to understand the industry. Before you start your analysis, you need to understand the industry that the business you're analyzing is. Then you will say, okay, if it's an FMCG business, okay, I need to focus on the gross margin. I need to focus on the inventory turnover. So you're able to know which ratio will be useful in carrying out your analysis. So yeah, so that's just that. So let's just move on to the next because of our time. So the next thing is we're looking at the business models as well as the cost structure. Yes, the business model as well as the cost structure. So that's the next thing we would be looking at. Yes, that's the next thing we would be looking at. So when we're talking about the business model, what do we mean? So the business model, just like you're seeing on my screen, says that it defines how a company creates value. How does the company create value? How does the company delivers value? And how does the company captures value? So that's the business model. So you need to be able to understand, okay, how does the company generate revenue? How does the company, allocate resources, So, and that's why we have different things here. So just like we have the revenue model, we have the resources and capabilities, we have the cost structure, we have the value proposition. So yes, so under the revenue model, we ask ourselves, what drives the income? What drives your income? The sales? Is it the sales? Is it the subscription? Is it the fees? Is it the ads? So what drives your income? So for technology firm, for instance, is the subscription that drives the revenue. The more subscription you have, the more subscribers you have, the more revenue you generate. For FMCG, the more products you sell, the more revenue you generate. So you need to know what drives the revenue, what drives your income. So that's under the business model. So you also look at the resources and capabilities. Yeah. So the resources and capabilities means that what do you have to generate this revenue? So the assets you have, the people you have, what are the processes involved? Yes. If you have good assets, you have very good people doing the work, but you don't have your processes are not good enough, it's gonna affect you. So as a business, so these are the things you look at as an analyst. So you look at the business model, the revenue model, the resources and capabilities of the business as well. Then also the cost structure. I explained the difference between the fixed cost and variable cost earlier. You need to also look at the differences. Then you determine the economic of scales as well as the operating leverage. So yeah, so don't worry, some of these terms you are not familiar with them, but as time goes on, you would understand them better. So the value proposition on the other hand talks about why customer choose this company over competitors. Now, there are some businesses that maybe their product is even very high, but people would rather patronize them than other competitors. So you need to ask yourself, why is it that people like patronizing this business? Yes, yes. So, and it's most likely because of the value proposition. So, yes, so your business should have that value proposition. So, if you're analyzing a business, you would begin to ask, okay, what's the value proposition of this business? Yeah, so that will also be one of the things that you consider as part of the business models as well as the cost structure. So yeah, we're looking at the impact of operating leverage. Now, when we're talking about operating leverage, just like the definition here, operating leverage is the extent to which a company uses fixed costs to generate profit. Yeah, so that is what operating leverage means. Yeah. So an extent variable cost affects profits, but there are some when you're looking at it from the perspective of fixed costs, like your fixed costs, a very good example is rent. Yeah. So what's the impact? To which extent does your rent help you to generate profits? So yes. So that is actually the impact of operating leverage. So the leverage can either be high or low. So for the high leverage, high fixed costs, high leverage means that high fixed costs, um, at times, small sales change leads to disproportionately large profits change. And okay, this is actually common in manufacturing. So manufacturing, you have to for you to manufacture your product, you have to incur cost to buy the machines. Yes, you need to have the machines. You need to have the machines. When you have the machines, then you can now use the machine to produce what you produce. So you first of all incur the cost of acquiring the machine. And that the cost of the machine will most likely be seen as a fixed cost, at times sunk cost. Yeah. So uh if you make small sales, it leads to what? Disproportionately large uh profit change. So now, what this means is that small sales change, like if before you have like let's say 50 million profits and sales rather, and there is a small difference in the sales because the cost, your fixed cost is still the same thing. So if your revenue increase is most likely going to increase your profit. So even if there is a small increase in revenue, if there's a small increase in revenue, that small increase in revenue will also affect the profits in a way. So yeah, so that is what we are talking about here under high leverage. So for the low leverage, we say that flexible cost structure. So profits are more stable and less sensitive to fluctuation. So just like this high leverage now, for instance, if the sales reduce, it can affect the business, especially if the business does not even meet up to break even. So that is what high leverage is all about. But for low leverage, it's kind of flexible and it also help profit to be more stable. It also help profit to be more stable. So yeah, so that's that. So a very good example is mentioned here. A cement plant with high fixed costs, we see profits increase significantly with just a small rise in capital utilization. So yes, financial analysts also take note of the sensitivity. So we also look at sensitivity analysis in our next class. Now, the third thing we are looking at today is linking strategy to financial outcomes. Yes, every financial result is the outcome of a strategic choice. So strategy is very, very important in our financial decision. Yes, strategy is very, very important in our financial decision. Analysts must trace, observe financial performance back to management strategic decisions and project the implications forward. So if you are a financial analyst, you can be employed as a financial analyst for a company. And what you do is you do financial planning and analysis from time to time on a monthly basis, on a weekly basis, on quarterly basis, on a yearly basis, as the case may be. Yeah. So that's a career path. So we also have some other set of people that they are consultants. They analyze financial statement of businesses. So yeah, so just like the big four, KPMG, Deloitte, EY, PwC. So these companies, they have financial analysts in their team such that any company can say, oh, we want to outsource our financial analysis to your team. So we need your guys to come to us, analyze our financial statement for this period, and we're going to pay you for that. So that is working as an external consultant. Yeah, so as financial analyst, you can do this also. So yeah, so we look at different strategies here. So there are different strategies that would also have an implication on the financial results. So a very good example is cost leadership, differentiation, market expansion. So these are different strategies. So now a business can focus and say, look, oh, I want to be the cost leader of this business. Now, cost leadership means that you have a strategy on giving a competitive price. Like your business is able to minimize costs such that you are able to give the minimum price possible for that product. So maybe you have a special arrangement with the suppliers and say, oh, we're going to buy in large quantity And because of this, you're going to give us discounts. And so, yeah, you are able to have access to all these so that you can reduce your price to the barest minimum. So yes, this technique can be adopted for FMCG, for instance. So financial impacts is that the lower unit margins, there will be lower unit margins, but high volume. So that is, people will most likely buy more of your products if your product is actually being sold at a very low price. So you can even hijack your competitor's customer as a result of that. If your business still has value and then you have it at a very low cost. You agree with me, when Biggie came into the business, their price was very, very low, ridiculously low compared to the big guys, Coca-Cola, Pepsi, and the like. So, but what happened? A lot of people patronized Biggie, and Biggie came out, people recognized them, and before you know it, the company did very well. So they were able to use cost leadership strategy then. So differentiation, on the other hand, is a strategy of offering unique premium products. So you're like, oh, this product is different. You can't even see it anywhere. No other person, no other company produce this kind of product. Even if they are producing, the quality is on the high side. Yeah. So you are trying to differentiate your product. Just like iPhone, for instance. iPhone, the kind of differentiate, the difference is actually unique. And that's why you say, iPhone 13, how much are they selling it? 5 million. iPhone 17, 6 million. And people are buying, unlike, Android that you can easily get at the range of 200,000, 300,000, and the likes. So this is what we call differentiation. For every iPhone sold, the profit margin is on the high side. Yes. So this is what we call differentiation. So as a financial analyst, you need to understand the strategy that the business is using, because this will help you to be able to analyze the business properly. So yes, and the next one is market expansion. Market expansion. So there are some businesses that are like, oh, they already have recognition in Nigeria, they're expanding to other part of Africa, or some business they have recognition in Europe, then they are extending to Africa and the likes. So yeah, so when you enter new region or customer segment, this is what market expansion is all about. Now, the impact is that there's going to be a rising capital expenditure, yeah, because you need to have a new, let's say, because you want to expand your business to another part of the world, you need to acquire properties, you need to acquire capital expenditure, you need to incur capital expenditure like buying PPEs and the like, property, plants, and equipment. It can also lead to potential debt increase, and there is always initial margin compression. So these are the things that you look at, and the analysts also understand all these and factor them while carrying out the financial analysis. So the real context is that, let's say, for instance, GC Co, yeah, um, diversified into payments and pensions. So yeah, so so this strategy immediately raised non-interest income, but temporarily increased technology and personnel cost. So this is like uh this is more or less like market expansion. They are trying to, okay, we don't want to do banking alone. We also want to do pension, you know, and all that. So actually that is actually that. So you need to understand the strategy that the business is actually using. And you can also advise as a financial analyst. The reason why you're analyzing the financial is to advise, oh, the strategy you are using is not working. Try this, try that, and the like. So yeah. So the next thing we'll be looking at is the analyst role in strategy evaluation. I think we're wrapping up already. Yeah, we're wrapping up already. So an analyst acts as a translator between strategic ambition and financial reality. So the analyst interpret. So when we say translator, it's just like, okay, for instance, let's assume that there is a Frenchman on this call. The person does not understand English. Yeah. And then there is a Chinese man here too. Before they can understand what we are saying, they need an interpreter. So the interpreter translates from English to their language. That is what financial analyst does. So analysts act as translator between strategic ambition and financial reality, quantifying the impact of management decisions. So the things that the management are not seeing, the analysts are able to see is with their technical skills, their abilities, and they are able to what advise management on what to do. Yes. So they help to interpret strategic choices, identify how executive decisions align with key financial indicators as well as industry trends, also quantify financial impacts, then communicate actionable insights to the users of the financial statement. So financial analysts must be able to tell compelling story, create and tell compelling stories based on what they have seen. Now, there's one thing to analyze, there's another thing to tell the story of what you have analyzed. So if you're not a good storyteller, you might have issues as financial analysts. So all financial analysts are good um financial storytellers. So yeah. So that is just that. So let's quickly look at this case review, comparing financial models. So we have different companies in different industries here. So we mentioned FMCG, telecom, manufacturing. So we'll be looking at them separately before we go straight to the practical session. So yes, we'll be rounding up with this theoretical session soon. And we'll go straight to the practical session very soon. Now, this theoretical session is very, very important. It will help you to understand what you should focus on while you're analyzing. So why you should not just calculate all the ratios. So for businesses, you don't need to calculate all the ratios for some kind of business. So if you understand the industry where the business belongs to, you'll be able to know, oh, which ratio will be relevant. Right, guys, so sorry about that. So let's look at the case review. As I've said, so we have oh, sorry about that. We have Nestle Nigeria PLC. So Nelsu is under the FMCG. So the model is product based and high volume, yeah, and it has a low leverage based on what I've explained earlier. So but if you look at Nestle as a company, they have stable revenue, they have moderate margins, and the margin is about 12%. So if you can just go online, check for their profit margin. I will show you how to check for the margins of companies yeah today. Success depends on operational efficiency and strong inventory management for cash flow. So because this is an FMCG company. So for telecom or tech, MTN, for instance, their model is subscription based and recurring revenue. So somebody bought recharge card today. You buy recharge card today, you are going to buy recharge card tomorrow also. So you keep on buying recharge card. The more you buy recharge card, the more MTN makes money. So that is the model. That is the revenue model. Then the insight is high recurring revenue, strong operating margin, and their margin is between 18 to 20%. You can check for the financial statement of MTN yourself to be able to understand. So now, what I mean is that telecom business, their margin is between 18 to 20%. So if you're analyzing a telecom business, for instance, and their margin is below this, then you should say that the company is not doing well compared to what is obtainable in the industry. So that is why this is very, very important. So it requires high continuous capital expenditure due to network investment, but offers high return on equity here. So that's what telecom business is all about. So for manufacturing, taking a look at Dangote Cement, Now for Dangote Cement, it requires capital, is actually capital intensive, and is also a cost leader. Yes, Dangote Cement is a cost leader in the industry. It has high operating leverage. So yes, there is high fixed costs, strong margin, sensitive to volume decline, but dominant market share. So yeah, so that is what manufacturing business like Dangote is. So yeah, so that is just that. Now to wrap up the theoretical aspect of this session, you guys are able to understand the industry dynamics influence and explain how different business models shape financial statements, link strategic decision to observable financial outcome, then compare different companies across different industry. So yeah, so that is just that. So because of our time, we'll go straight to the analysis. So now in our last week class, we looked at different statements. We look at the income statement, that's a statement of profit or loss, another comprehensive income. We look at statement of financial position. We look at statement of cash flow and the like. So you get the recorded video. It will be shared with us. So but yes, like we'll be going through. So this is a typical profit statement. This is how profit statement looks like. So it shows us the revenue, the cost of sales, the overhead, the operating profit, the interest expense, profit before tax, and the likes. So this is a typical income statement. So now I will show you how to do a vertical analysis. Are we still with me, please? I need to be sure that we are still with me. Okay, yes, thank you, Mrs. Modena. Ms. Abidemi, are you there? Are you still there? I need to be sure if you are still there.
Yes, I am.
Oh, okay, good. All right. So yeah, so this is Microsoft Excel, and we'll be looking at how to analyze financials. So I need to just remove some stuffs here. Need to remove some stuffs here. Yeah. So now the first thing is, let's say for instance, you are preparing the financial statement. You have your revenue. So you have total revenue. So total revenue is going to be, okay, you have only one revenue. So you can just say, now you use formula, you can use formula on Excel. Now, the way Microsoft Excel works, Microsoft Excel is a calculator. So those that attended my last class, I told them that uh, there was a time I just went to visit a friend in his company, and I saw one of his colleagues. She was working on Excel, and she has the figures on Excel, and she was pressing calculator while working on Excel. I said, how can you be doing that? How can you be working on Excel and you're pressing calculator? Because Microsoft Excel is a calculator itself. Yes, Microsoft Excel is a calculator itself. And by the end of this training, you understand how to use Microsoft Excel to calculate anything you want to calculate. Yeah, there are advanced mathematical tools you can use on Microsoft Excel. Yeah. So yeah. So now for total revenue, our total revenue is 14 million, Abi. Since that is just the only revenue we have, it's the same thing as 14,953 that we have here. So what we just do is we say equals to revenue. We just say equals to. The moment we say equals to, it will bring any figure that we have here. It will repeat it here. So it's telling us that the total revenue is just this revenue. It's just this revenue. That's our total revenue. Now we have cost of sales. Our cost of sales is here. Our cost of sales is there. So the cost of sales is 8,368,000. Our gross profit is actually the difference between cost of sales, the difference between revenue and cost of sales. So what we're going to do is we say equals to Now you use formula. Anytime you want to type formula on Excel, you start it with equals to. You start it with equals to. If you don't use equals to, there is no way Excel will not know that you want to type a formula. So Excel, anytime you press your equals to, Excel and identify that, oh, you want to perform a mathematical calculation, and Excel is ready to serve as the calculator at that point in time. But if you don't press equals to, Excel will not say that, oh, we not know that you want to calculate. So what this means is that if you want to calculate anything in Excel rather, make sure you start with the first thing you type is equals to. That's the rule. That's the rule. So equals to, we'll say 14 million, which is here. This is in C6. Now, this total revenue is in C6, just like when I click on it, I'm seeing C6 here. This C6 means that now on Excel, on Microsoft Excel, your cells, when we say cells, let me come back. All these things that you are seeing here, they are cells. They are cells. Now, these cells are named. They have their name. All the cells you have here, they have their names. If you come here, this is the name box. We call it the name box. As you can see, this name box tell you the name of your cell. So just like this cell now, what do you see on the name box? This cell that I am on was on the name box. Anybody? You can type on the chat or talk, please. This cell that I am now was on the name box. Anybody? Okay. G5, yes.
G4.
G5. G5 now. You said G5. Yes, G5. This is G5 because we are saying G5 on the name box. How did we get G5? If we go up, this is G. Now, Excel, the cells is a coordinate where the rows and column meets. That's the cell. Now we have different columns on Excel spreadsheets or worksheets, and we have different rows. The columns are represented by alphabet, just like here you are seeing A. So this is saying that everything here is under A, B, C, D. So we have a lot of numbers, letters at the end. Then the rows, we have 1, 2, 3, 4. In short, we have millions of rows on Excel. So it's telling us as this particular cell that we highlight is on G5, is on G5, is on G5. So who can tell me, I will not click here. Who can tell me this total revenue that I am on? That I didn't click on it, so don't be misled. So what will be the name? What will be the name on the name box if I click on it? This total revenue that my this thing is touching now, that is showing 40 million. What will be the name on the name box? Anybody? Oh yeah, guys, please, I need you to talk. This is where the work has started, though. We are doing financial analysis. So this is the beginning. So yes, so this will be, what will be the name box? This one. Okay, let me check. C6, is it 6? Yes, 6 is correct. So let me click on it, C6. Yes, 6 is correct. Bidemi, I'm not hearing your voice, so are you sure you are with us? Bidemi, kindly unmute. Let me hear you.
Okay, C6.
Okay, what about the cost of sales? The cost of sales, where was the cost of sales?
C7.
C7, good. Maybe you should mute your mic. Anytime you want to talk, you can just use the chat. I guess your environment is a bit noisy. So yes, so Now we want to find the difference between revenue and cost of sales. So what we'll do is equals to this revenue is under C6. That's why you are seeing C6 here. So Excel will name it will name the cell based on the words on the name box. So the total revenue is C6 minus cost of sales is this, which is C7. And if you press equals, if you press your enter, it's giving you the difference. If you press your calculator, find the difference between this and this, it will give you this figure. Yes, I can confidently tell you, it will give you this figure. If you want to prove, you can prove. So that is, so our gross profit is 6,584,000, which is the difference between the revenue and the cost of sales. So now the next thing is our operating profits. Now, our operating profits, our operating profit is equals to, now operating profit is gross profit minus, first of all, we need to know how much is all these expenses. So all these are expenses, right? So let me just, all these are expenses. So these expenses, to make it, for us to identify, I will just put this in negative. So I will change this to plus. So this is already negative. This is negative. So I will change this also to negative so that it's telling me that this is an expense in my P or L. I'll change this to negative also. I'll change all these expenses. Let me change all these expenses to negative. Okay. Interest expense is also negative. So I'm saying minus 100, like, okay, minus 100 is a negative, we should deduct. Income tax is also negative because it's an expense. All right, so now what I want to do is, normally if I want to know all my expenses, so these are all the expenses. If I want to know all my expenses, what I can just do is come here, say equals to sum, and I highlight all these together and press enter. So that gives me the sum of all these figures here. So that's another formula. Equals to sum, open bracket, then drag, let me type it again, equals to sum, open, you can press tab, or you can just click on this sum. Once you click on it, it says that you should put what you want to sum. You want to sum from selling general admin expense to other operating expense. So just highlight it. The moment you highlight it, so it's saying that this is C9 to C13. This column in between is saying that you are summing from C9 to C13. Then close your bracket and press enter. So it's telling you that all the expenses that you highlight here, they are 3,287,000. Yeah. The other operating expense is new. So, but our operating profit is going to be gross profits minus this, gross profit minus this, which is 9,872,000. Now, we can get our operating profit without doing this. How can we do that? So we'll say that equals to gross profit minus sum of this, and that gives us 9,872,000. So, oh, sorry. I'm supposed to plus because I've already put a negative sign. So that's to give us, I'm coming. Okay, that gives us 3,296,264. Yeah. So if you deduct 3,287 from, let's prove it. If you deduct this minus this. Okay, because this is a negative, I'll just say plus. let me do that again. Equals to this. I want to subtract this from this. So that's to give us the 3,296,000. Does anybody understand what I'm doing here? Does anybody has a question so far? Any question for me? Is it looking difficult or is looking simple? Let me get your feedback. Let me get your feedback. Is it simple or difficult? Madam Modinat. Oh, well understood. Good. Abidemi. Okay, that's good. Mrs. Olarewaju, are you with us, ma? Do you understand what we have explained so far? I'm not sure Mrs. Olarewaju is still with us. Okay. So I will just continue. Oh, wow. I can see Mrs. Sadiq with us. You're welcome, ma. It's good to have you on board. Even though we've gone a bit far, we're almost rounding up with the class. But anyway, it's not too late. We still have about 1 hour to go. Yeah, you're welcome on board. You're welcome on board. So let's just go ahead. So we've done our operating profits. The next thing we need to do is profit before tax. So profit before tax is operating profit minus interest expense. So we can quickly do that. So we say equals to, it's supposed to be this minus this. So since this is already negative, we'll say plus this because it's already in negative. So there's no point minusing because minus times minus is plus, but plus times minus is minus, and that's why we're using plus sign here because this is already negative. So by the time we deduct 100 from 3,296,264, we are having this figure. So yes, the next thing is income tax should be deducted. So the formula that we're going to use here will be equals to C18, C16 rather, which is where the profit before tax is, then plus 809. The reason why we are using 809 is because this is already in negative. This is already in negative, so you can use plus. So if you use plus, it's going to subtract. Yes, as you can see, 2,480,000, which is less than 3 million. But if you minus, let's see what happens if you minus. If you minus, it's increasing. Can you see? It's increasing because there is already a negative sign here. There is already a minus sign here. So if you are minusing from a minus sign, it means you are adding. That is the rule of mathematics. If you minus from minus, minus times minus is plus. It means it will plus. But since this already has a negative sign, so what you can do is just add instead of subtracting, because the goal is we want to reduce that figure since you are comparing a profit and an expense. So we use the plus symbol, and that gave us the profit after tax. Now, extraordinary items, we don't have an extraordinary item here. The figure is new, so we'll just go ahead. Now, there is a formula on Excel that gives you auto sum. That formula is alt, that is ALT. If you press your ALT and equals to, if you press your ALT and equals to, this is auto sum. Now, this auto sum, I cannot use it because it's telling me, do I want to sum C5 to C19? No, that's not what I want to do, but I can modify. I can modify to say, okay, let me sum just this and this together. Yes, C18 and C19, that's what I want to sum. And I'll press my enter. Oh, sorry. Let me take it up a bit. C18 and C19 and press my enter. So as you can see, it has given me the exact figure that we have here. It has given me the exact figure that we have here. So that is that. So that's the first phase of this. I don't know if there is any question for me before we move on. Let me know if there is any question. Are we clear? Now, you already have an illustration here. So there is an exercise there that you're going to do. Yeah, there's an exercise here that you're going to do. I will share this file with us when we are done. I'll share it on the group so that we can have access to it. I'll share this file on the group so we can have access to it. So, yes, so if you have any question now, please ask so that I can attend to your questions so that you will not have any issues with the assignment. For every class that we do, there will be assignments. Yes, and it will be rated. So you have to submit before the next class because these are part of the things we consider before we issue your certificates. So yeah. So that's and attending class is also very, very important. So just like today now, we only have 3 people that join the class out of how many people that register. So these are some of the things that we're also going to consider when issuing the certificate. Anyway, that's by the way. For those that will listen to the video, if you are not attending the live class, these are some of the things that we also take cognizance of. Yeah. So I will just appeal to everyone. Let's try to create time. Yes, I've also had a very busy day, but I'm here hosting the class. So if I can do this, so let's also try as much as possible to be here. It's just once in a week or at most 2 times in a week. So for us to do this. So yeah. So we are still on the vertical analysis. So now what we have just done up to date is just to be able to identify the formulas that can help us to add and subtract. So what we have done so far is just to prove to you that Excel has calculator. You don't need to press calculator while you are working on Excel. You can use the formula while you are working on Excel. Yes, you can use your formula while you are working on Excel. So you don't need to do the hard work by saying, you want to press calculator and calculate. So now we'll be looking at some of the profitability ratios. So we have profitability ratios, we have efficiency ratio, we have solvency ratio. So even though in our next class I'll explain more on this. Okay, so maybe I should suspend that so next class because that is most likely what we'll be focusing on in our next class so that yeah, I think that's what we're going to do actually. So or better still, let's start today. Let's start today so that in our next class we'll just see, since we still have a lot of time, yeah, we still have like 45 minutes more. So at least let's use that so that at least we'll move at a very faster pace and we'll be able to cover what we need to cover on time. So I'll be introducing us to ratio now. Yeah. So we have different types of ratios. We have the profitability ratios, the efficiency ratio, solvency ratio, and we also have liquidity ratio. Okay, for now I don't have liquidity ratio, but I would introduce you all to ratio next week. But we are just trying to start with something today. So yes, when we're talking about profitability ratios, there are ratios that help you to analyze your profits, the profit of the business. So we have the gross margin, or you can also call it the gross profit margin, and that is a gross profit over sales. Now, when you are recognizing ratio are mathematical formulas that help you to analyze your financials. So yeah, so when we're saying gross margin, it means that, oh, Margin actually means divided by sales. If you are saying margin, it means divided by sales. That is divided by revenue. Okay, I think let me just replace the sales with revenue. Now, okay, now I'm having sales here. Let me just use this to teach you. But I want to change it to revenue because I have revenue here, and most likely you are going to see revenue. For those of us that have been working with a financial report in line with IFRS, you will agree with me that it is revenue that you would most likely see. Yes, in line with IFRS. So I'm not seeing sales here. I'm feeling kind somehow. So I want to change the sales to revenue. So what I will do is I will press Ctrl C on the sales. Now I will find and replace the sales with revenue. How do I do that? I'll press Ctrl F. Ctrl F is the shortcut to find. Please take note. Ctrl F is the shortcut that is used to find. So I press Ctrl F. Now Ctrl F is already, since I already select sales, it says find what? What do you want to find? I want to find sales. If I click on find all, so it's telling me this is where you can find all the sales that are here. Yeah. Okay, so wow. I have cost of sales. Wow. Okay, I don't want to change the cost of sales. Okay. So how do I do this? So I use option. I use option. I will say match entire cell contents because I don't want to change cost of sales. It's only sales that I want to change. So match entire sales content. Then I say find all. So now, if I find all, you see that there is no cost of sales anymore. So it's telling me that I have three sales, and the three sales are here. Yes, the three sales are here. Sales under gross margin, sales under operating margin, sales under net profit margin. So those are the three sales that I want to change. So that's the first thing you do. Then when you are done, you say replace. I want to replace these sales. I want to replace these sales to revenue. Then I click on replace all. Don't forget I have three sales here. I will click on replace all. Now it says all done. We made three replacements. I click on OK. So if you check now, we're now seeing revenue here. So this is how to make your work easier so that you don't have to be typing revenue. Delete sales, type revenue here, come here, delete it and type again, or press Ctrl C, Ctrl V. That will waste your time. So imagine if you have like 1,000 sales that you want to change to revenue, it will take you a lot of time. But just using this formula, it makes your life easier and faster. So that is how to use the find and replace on Microsoft Excel. Does anybody has a question before we move on? Please, if you have any question, let me know so that I can answer your question before we move on. Okay, let me just get feedback from us. Are we enjoying this class so far? How have we learned any new thing ever since we've started? Or it's like, or maybe we already know all these things? Do we already know these things? Have we learned anything new? Are we getting value from this class? So let me just hear our feedback before we go on. Yes, Bidemi, let allow you to unmute and talk to us. So share with us whether have you gotten any value so far from this class? You can unmute.
Okay, yes, I'm learning. And it's been so exciting time. It's, yes, I've gotten value.
Okay, what's the new thing you learn? You will learn it ever since the class commenced? Did you get my question? Can you just mention one or two things that you've learned? Maybe a new thing you learn ever since the class commenced, because I need to be sure that we are really getting value from the class. Or you don't want to tell us? You can unmute, so or somebody else should talk, please. Let's make the class lively so it doesn't look like I'm the only one talking. So I need to hear this feedback from time to time so that at least I know I'm not talking to myself. So please let's unmute and talk or use the chat. Mrs. Modena, are you still with us? I've not been hearing your voice for a while. And Mr. Sadiq, are you with us also? I need to get this feedback. Yes, I can see that BDME has put in the chat box that she learned how to use Excel to calculate and analyze financials. So yeah, we'll just continue. We'll continue. So this is how to use the find and replace. It's a very handy tool on Microsoft Excel. So yeah, so now let's quickly go straight to the ratio. So the gross margin, the ratio is a gross profit over revenue. So what we do is we come here, so we use our formula also. We say gross profit divided by revenue. How do you divide on Excel? It's very simple. So just say equals to your gross profit is here. This is on C8, just like you're having here. So C8 is gross profit. Divide. So you use this symbol. You can see it on your keyboard. Yes, is the second to the last row on my keyboard is actually on top of control. So we have to control one on the left, one on the right. So control on the right hand side. So the symbol on it, the symbol on top of the control is what I press, and that gave me this division symbol. Yeah, or stroke. We call it stroke as a punctuation mark. So yeah, divided by revenue. Our revenue is 14,953, so that is on C6. So C8 over C6 means gross profit divided by revenue equals to what? 44. 44. Now, there's a way you can format your um okay, let me just, if you want to format to number, what you do is you come here, you press Ctrl 1, then you click on number. You click on number. If you want to use 1000 separator, you click on it. You want to use decimal place, click on it. Then I want to use I want to represent negative figures to be in brackets. So yes, I click on it, then click on OK. So as you can see, this is showing 0.44, but now I don't want this to be showing as number. I want it to be showing as percentage. So what do? I right click, I highlight all the cells, the column. I just come to where there's E here, click on it, then press Ctrl 1, then come to percentage. Percentage, how many decimal? I want only one decimal place. So this is now, if I click on OK, you will see that this that is showing number will now show percentage. Let's click on OK. So as you can see, this is now showing 44.0%. So that is actually how to change the format. Yes, how to change your format. So for operating margin, that's the next ratio for us. The next ratio is operating margin. It's also one of the profitability ratios. Don't worry, in our next class, I'll tell us what these ratios are meant for, but for now, we'll just calculate them. So your operating margin is EBIT over revenue. EBIT is earning before interest and tax. And your earnings before interest and tax, where is it? What represents EBIT in your income statement? Can anybody help us quickly? What represents EBIT in your profit statement or in your income statement? Please, I really want us to be active. Let's be here so that we can also follow through the class. Yes, anybody who is helping us out? EBIT. Or does that mean nobody here knows what EBIT is? Mrs. Medina, do you want to help us now? Earnings before interest and tax. That's what EBIT means. So where can we find our EBIT here? Okay, because of our time, I guess we are very, very tired. So our EBIT is operating profit. So operating profit is our EBIT. So we can call it EBIT also, which is earnings before interest and tax. And that is our 3296. So our operating profit margin equals to EBIT, which is here, divided by revenue. Our revenue is this. So just press enter and that gives us 22%. Our EBIT is 22%. So net profit margin is net profit over revenue, net profit divided by revenue. So that's equals to our net profits. This is our net profits divided by revenue. Revenue is here. So you can come, so it's saying C20, which is this over revenue is C6. So just press enter. So that gives you 16.6%. Yeah, 16.6%. So that is all about the profitability ratios, even though we have more profitability ratios and we're going to learn more when we meet next week. So the next ratio we'll be calculating is our efficiency ratio. So from here, I think we can calculate our tax ratio based on the information we have here. There are more efficiency ratio, but this is what we can calculate so far. Yeah. So tax ratio is tax expense divided by earnings before tax. Earnings before tax is also profit before tax. So we say our tax expense equals to, this is it, income tax. This is our income tax. Now, this is showing negative, but I want it to give me the absolute figure. So I can use ABS formula. So the ABS formula return the absolute value of a number without a sign. So it's going to eliminate the negative symbol here because obviously the negative symbol will affect the figure. So I'll put ABS. So the ABS is going to neutralize the negative sign. I close it. Then I say divided by what? Earnings before tax. Our earnings before tax is actually profit before tax. So that's what income tax expense divided by profit before tax. So that's what 24.6. So if I press F2, F2 checks, help you to check what is involved so that you can check, okay, are you truly correct? So as you can see, it's just income tax and profit before tax that were highlighted. So you press your enter. So that's your tax ratio. And the last ratio we'll be looking at today is our interest cover ratio. We have more ratios anyway, but we'll look more into these next week. So our interest coverage ratio, we have EBIT, which is earnings before interest and tax, divided by interest expense. So our EBIT is actually operating expense, which is this, divided by, that's 616, yes, divided by interest expense. Interest expense is 100. Now, Interest expense, we will use the absolute figure because this is showing negative. We don't want the negative symbol. We'll use the absolute figure. So use your apps symbol here and click income tax. Close your brackets. Now, by the time you press enter, it shows you the interest coverage ratio. Now, the interest coverage ratio is going to be reported in times. Yes, it's going to be recorded in times, not in percentage, in times. So this is showing that this is 4.1 times. This is showing that this is what? 4.1 times. So, so that is that. So that means your interest coverage ratio is like 4.1 times. Wait, I'm coming. 616 over 617. Yeah, that's your, sorry, what am I doing now? This is interest coverage rather. Okay, so what did I do? EBIT over interest expense. I can see that that figure was ridiculously low compared to what I envisaged. So interest expense is on C15 actually, not C17. Yeah, C15. Interest expense is on C15. So yeah, so this is showing 32,961 times. Yeah, that's the figure. Now, I'm going to explain. So this is showing that the interest expense is 100, but our EBIT, which is the operating expense, is 3 million. So it's saying that this 100, you can find 32,961 times of the what? Interest in your earnings before interest and tax. So that is what the interest coverage ratio is saying, is showing that, okay, how many times can you pay your interest from your operating profits? So that is what the interest coverage ratio is looking at. So it's telling you that, oh, you can pay your interest 32,961 times. So that is what, okay, we can just approximate this to the nearest whole number. 32,962 times. So that is the interest coverage ratio. Okay, so so that I don't complicate things. This is where we're going to stop for now. When we meet in our next class, we would dive into more of the ratio analysis. So I will introduce ratio from the beginning and we'll take it to the advanced aspects. So yeah, so this is where we're going to stop for today. Does anybody has any question? Does anybody has any question for us? Any question, please? So let's use the remaining minutes to take our questions. Wow, this class is, should I say this class is too cold, unlike the classes I've had in the past? Yeah, I know maybe someone will have questions, contributions, additions. So please let's share ideas. If you already understand this, you can also tell us maybe one or two things that we didn't mention while this class is ongoing, or maybe anything you would like to add so that we can all learn because we are all here to learn actually. So yeah, so let's ask a question if there is any, or if there are any questions, let's ask. If we have observation, suggestion, let's also talk about it. So let's be free, yes, let's be free, yeah. So who is talking? Please, you can unmute. You can unmute, please. Okay, I guess we don't have questions.
Okay.
Bidemi, do you want to ask question?
Yes, I want to see the question that leads to this solution. I don't know if it will be available.
So like,
Do you
uh,
get
there is no really like question, but like,
it's just assumption, right?
yes, like this is a company's financial statement, so it's telling us that the revenue is this figure, and we're able to get the profit, but
Okay.
so this is just like okay, the gross profit margin, the formula is gross profit over revenue, and we are just trying to now the reason why I explain this is to able to make us understand how to use Excel formula. That's the whole essence of the class. So because by the time we multiply, we start multiplying, divide, add, subtract. So you get familiarized on how to use the Excel formula. That's the whole essence of what we did. Yeah. So yeah. So at least performing basic operations like addition, subtraction, division. Okay, we didn't do multiplication today. We did not. But in our next class, we would look at how to multiply on Excel. But I can remember we did addition, subtraction, and division. So yeah. So so it's not like there's a question because the question is already here. It says, okay, find the gross profit, gross margin, and we've found it here also. So it's more or less like what you have here is the question. Yes, what you have here is the question. What I highlighted here is the question, but this is the answer to the question. Does that make sense? Miss Bidemi, are you still there? You can just use the charts if you don't want to talk, because I understand your environment is a bit noisy. Does anybody has any other question? Oh, okay, good, good. All right, all right. So, in the absence of question, this is where we're going to stop today. This is where we're going to stop today. So, you can just share what you have learned so far on the group, at least to motivate people that are supposed to join this class, but they did not. So let's try as much as possible to share what we actually, the value we've gotten from the class. Okay, I'm not sure BDM is on the group already. I think I would add um, I'm not sure BDM is on the group. So let me just add that now. So let's share what we've learned in the class on the WhatsApp group so that those that are supposed to be on the call right now that they are not here, they would also be motivated to join us in our next class. So yeah. So that's just that. Okay, so all right, thank you guys. I'll be sharing the Excel sheets. This Excel sheet says, let me save it. I will save it and share with us. So you would at least you will see what we have done so far. But the assignment I'll be giving you all is this vertical. So we've done vertical, right? This exercise on vertical, I'm going to color the tab. I'm going to color the tab green. So this exercise on vertical that the is colored green is your assignment. So yeah, so we should complete it. So like the revenue, the gross profits, everything that we need to bring in here. Let's make sure we bring it here so that um so that yeah, so that we need to complete this we need to complete this table or these profit statements.